All right, let's make a start. Thank you very much for joining us, ladies and gentlemen. It's a busy day, a busy afternoon, and lots of choice in these events, I'm aware. We're a parallel session. But I'd like to say, I think we are the most important parallel session. I'm sure everybody else is saying that as well, but none of the rest of it happens without the money. And here is where we're going to be discussing the money. My name's Robin Amlo. I'm the managing editor of CPI Financial here in Dubai. We publish a couple of magazines all about money, Banker Middle East and Banker Africa. And that's pretty much why I am your moderator for this session. Joining me up on stage is Dr. Mohammed Omran, chairman of the Egyptian Exchange, Amir Sheikh, Chief Legal Counsel for African Legal Support Facility. He's based in Tunisia, and he's asked me to point out that the African Legal Support Facility is part of the Africa Development Bank Group. Next to him is Stella Kilonzo, who is the founder of Astute Capital Kenya and has been involved in the capital markets development team there. Hitaj, and I can't read my handwriting, Asapota of Emirates MBD Capital is next. And, oh no, he's right at the far end, I'm sorry. Before him we have David Ofunji, who is the Regional Director of Blue Financial Services and the founder of Dero Capital. Ladies and gentlemen, this is your panel. The format of this, insofar as I would like to be able to do it, is going to be informal. Nobody is going to be making a presentation. We are going to have a conversation and possibly an argument in one or two places up on stage. And we'll do that for about 35 or 40 minutes, and then please feel free to join in, because we want your feedback, and I'm sure you'll have questions of some of our panelists here. So just to set the scene, things have changed an awful lot, have they not, in the last decade as far as Africa is concerned. I've got some very basic numbers here which I'm going to quote to you. They're from Thomson Reuters. In sub-Saharan Africa in 2012, there was $4.8 billion worth of equity capital market issuance. In debt capital market issuance, $11.8 billion. And $25 billion worth of activity in mergers and acquisitions. We have capital markets that are active. We have capital markets that are growing and evolving. But what's actually been behind the change? Where's this coming from? And I'd like to start with that. Hitaj, as the investment banker on stage, perhaps you could set the scene for us.
Thank you, Robin. Well, to all those who are visiting from outside Dubai, on behalf of Emirates NBD, wishing you a very warm welcome to the city. In terms of capital markets, what we've seen is a very fundamental shift in the way financing happens. If you just step back a few years to 2006, about 50% of the financing in the US market happened via capital markets, but only 25 to 30% of the financing in Europe happened via capital markets, and only 5% of the financing in the Middle East happened via capital markets. Fast forward 3 years to 2009, and we saw corporate bonds in Europe exceed corporate loans in Europe for the first time ever. And the margin by which they exceeded corporate loans was very high, fundamentally driven by banks deleveraging, Basel III capital requirements, placing more stringent rules on capital and longer-term financing, very strong demand from investors outside the banking market, and so on. So in summary, we've seen a very strong shift where capital markets now are a very essential part of financing for not only developed markets, but also increasingly emerging markets like the Middle East. And going forward, we expect that to only gather more force. In terms of, in the context of Africa, what I'd like to summarize with is that's a very important tool to access capital, which is one of the few key hurdles that Africa has in terms of growth, and putting the right regulations and putting the right infrastructure in place to access that capital will be very essential for the next phase of growth.
In terms of Africa's capital markets, of course, we have seen some startling, and I do use that word correctly, I think, startling successes. There's another gentleman on stage who has those numbers, who insisted on bringing his iPad with him. Emir, perhaps you'd like to cite those figures that you were so worried you wouldn't remember.
Sorry, I apologize. I have outsourced my brain to my iPad, so all my memory is sitting here next to me. One of the things that we've been seeing more and more of, and seems to be garnering interest, is the sovereign debt markets. There we go. Is the sovereign debt markets. So in particular, just last week, Rwanda placed a $400 million Euro bond that was oversubscribed to the tune of $3 billion. And then after that, or just prior to that in 2012, Zambia had issued a 500 million euro bond, and it was oversubscribed by a factor of 16. So they ended up reissuing and selling $750 million worth of debt. These are some of the examples of sovereigns beginning to tap the markets, the international capital debt markets, which are a prerequisite before commercial entities can enter the international capital debt markets. So without the sovereign bond rating as the basis, that basic, okay, the government can pay, that really opens up the commercial paper markets.
Well, what's actually changed? So nobody's explained to me yet what's actually changed that makes this feasible, particularly in sub-Saharan Africa. Stella, David, perhaps you'd like to enlighten us on that.
Yes. What has actually changed in the African landscape is really demand for infrastructure that has, and the policy decision for African governments, especially to invest in infrastructure. That has created demand for debt. And how Africa, especially Kenya, has practiced it is by issuing infrastructure bonds. As I said, and just taking on from what was said earlier, liquidity did dry up in Europe, and there was need to obviously look at greater ways of financing. And that greater way of financing is by obviously using the local denominated currency bonds, which again were geared towards infrastructure. And fiscal incentives were also provided for the Kenyan investors and also the foreign investors. So they were all treated the same. They were not, there was no distinction whether you were a Kenyan investor or whether you were a foreign investor. And so you found that you could actually earn even an 18% return because any infrastructure bond that was issued with a duration of over 3 years actually had a tax waiver, and there was no capital gains tax on the same. So what has actually changed is obviously looking at Africa, looking at where the returns are, because in Europe and probably some of the other developed markets, the economy was not doing that great, but you can actually have the returns in Africa. Then the demand for infrastructure is big. The demand for us to have infrastructure to finance the mining, the oil and gas, housing, you name it, is right there, the roads as well. So that has been a key issue as well.
If I may just add, Robin, I think the key theme we picked up in the plenary sessions today was the bridge that we need to, the divide between the perception and the reality, which may be a surprise to many here, but that's progress, because prior to that, it was bridging perception and a very distorted reality about African capital markets. I come from the other side of the fence where the business I represent, Blue Financial Services, is doing good things in microfinance in Africa. We are hearing a lot about the potential, but it's just key for Africa to convert that into the kinetic. And one of the things that we're facing still in capital raising is the situation around the perception of credit risk. We still have to go through DFI intermediaries to get balance sheets. We still understand that there's a place for that, but last time I heard, I don't think Mark Zuckerberg went for USA to bridge his risk profile when they were listing Facebook. I think with returns that was spoken about earlier today, 57% in Zambia and high or low 30s in Kenya and Uganda, I think the capital has to really be mature about appraising risk, and from that perspective, the money has to follow suit. And I think that conversion is where we're really going to take off from the current status quo.
I was also going to say, I think one of the big changes has been the growth of the middle class. It's led to a shift in the economy away from its overdependence on the super cycle of commodities and a switch to actual consumption. You've now got over, I believe they estimate about 350 million Africans are in the middle class, making above the poverty line now. So there's been a fundamental shift, especially in the last few years. There's been a real push upwards in the pyramid, I guess.
And I may also add, locally grown companies are also a big stakeholder. We have seen local consortiums who are basically investing, so they're not necessarily small, medium enterprises. They may have started out as that, but they're now growing. And we have local private equity companies. For example, in Kenya, we have TransCentury, and it's invested in a whole conglomerate. I'm sure there are examples in all of Africa. And these are also making, they're also issuing debt. So corporate debt is something that they're issuing, be it infrastructure bonds for housing. And so you're finding that over-reliance again. They know the risk. They have done business in Africa. So they are able to actually say, I'll be able to issue this, or I'll be able to undertake this transaction without necessarily relying on that US aid or some of the other development partners.
Well, it seems very basic. It is very basic to say this, but for capital markets to work, for any capital market anywhere to work, its raison d'etre, its reason for being, is for governments and corporates to raise money. But for people to be prepared to buy into that, there has to be a ready secondary market as well. People have to be able to get their money out, and to be able to get, and these instruments have to be tradable, which means you have to have institutions and indeed individual retail investors prepared to trade these things. The growth of the middle class in Africa creates a constituency that would be prepared to do that, whether they do it as individual investors or whether there's a pension fund doing it for them. But if we can come specifically to a market now, that the representative of a capital market sitting here, of the Egyptian exchange, what are the lessons that what is, I believe, the second largest exchange on the continent has for the rest of Africa?
Yeah, actually, before we start talk about the market itself and your previous question of what is changing, the changing is a natural of what's happening in the world economy. 40, 56 years ago, talking about the sophisticated markets, and then we were talking about emerging markets in Latin America, and then we're talking about emerging market in Asia Pacific. Now times come to Africa. So I guess the next destination for investment and for the continuing activities in the world economy will shift to Africa. In the last 20 years, we were talking about the emerging market in Latin America, Asia Pacific. Now the next destination is Africa. But what is important here is that most of the countries in Africa and in the Middle East, they are bank-based economy. When we're talking about the financial structure of any economy, we're talking about bank-based economy versus market-based economy. But recently, in the last 5 to 10 years, there is a little bit of shift from banking to be dominating activities in the access to finance. Slightly, we are moving to the capital market. And our experience in Egypt is that in the last 10 years, instead of the banking sector in Egypt was dominating around 90% of access to finance or providing lending to corporate and individuals, now we are talking about the range of 75 to 80%, and 20 to 25% are moving to the capital market. Thanks, of course, for the good economic policies, including financial liberalization, including privatization policies, as well as to set in place the right regulatory framework. So the most important thing before you are starting to enhancing your market is to understanding that you have the right tools in the market, not only in terms of the regulatory framework, but more important is to enforce this regulatory framework. I still remembering one of the best paper I was reading when I was working in the academia. I think it's a paper published in Journal of Political Economy about the law and finance. I think that was the Shriver, Laporta, and other people, and they were talking is that rule of law is very important. What is more important is how to enforce this law and make it work.
In Kenya, to attract the retail investor, if you couple that with deregulation, for example, of the pension sector, which really means that competitive fund management has to look out for smart investments in the capital markets. I also want to add the point around the perception around sophistication risk in our investor base. I'm not much of a biblical person, but my mother told me about this story in the Bible when Moses had this dream, and he told about the harvest that needed to save for 7 years because of 7 years of drought. I didn't go to Sunday school much, but that is essentially the first case of securitization in history. So we know a thing or two about this. I think the market is a few steps ahead of the retail market is a few steps ahead of the creators of these instruments. We're currently involved in an ETF product that will really erase the perception of liquidity risk because there's essentially a counterparty all the time. So I think the market is ripe. There's domestic capital. I think you saw that with Safaricom that would latch onto these instruments to the extent that they're issued within the scale, tenure, and everything else for the retail investor locally.
And we have to also be cognizant of the government policy and of the fiscal incentives that have been provided for these particular products. And we always say, it is important if you have an ETF or a securitization product, it is good to figure out what the policy is. So, for example, in Kenya, the policy is really to ensure that that special purpose vehicle that is created for the securitization, the income that comes from there is actually tax exempt for a period of 10 years, and also the capital gains are not actually factored in. So securitization is something that the law has, the regulations are already out in Kenya, and I believe the rest of East Africa is also looking at harmonizing those regulations so that we now currently have our Kenya Electricity Generating Company, which is called KenGen, is currently in the midst of issuing a 300 million securitization. That will be, again, a game changer and an example for the rest of Africa in terms of how to issue asset-backed securities and actually ensure that the returns from that asset-backed security are coming from the electricity that is generated and sold to the power distribution company.
You used that phrase, I love you, thank you, asset-backed, because I want to move us on to, you talked, David, about ETFs, but I want to move us on to another form of finance, because obviously what's happening as the capital markets in Africa evolve and mature is the addition of new forms of capital, new types of instruments. We cannot not talk about Islamic finance. Particularly, congratulations.
Last night,
the law was passed in Egypt.
The Shura Council has approved the sovereign Sharia compliance kind of products, and I guess it has been a while discussing about the asset classes in any economy, and for Egypt, for example, recently there are some believe that there are some asset classes in which investors are waiting for, and one of them was just last night when it has been approved, the sukuk or the Sharia compliance kind of products. And I guess if it's well designed, and I was in contact with the Minister of Finance and the Governor of the Central Bank of Egypt, is that we do not need to repeat our mistakes, because recently the outstanding long-term sovereign bonds is approaching 200 billion Egyptian pound, which is something like $30 billion, but it's always not active at all. We do not have a secondary market. So the plan, if it's well designed again, is that when you are issuing the Islamic sukuk, you will find many retail investors, they are interested to participate in that. So it should be designed in a way not to be only for the primary dealer system in which only banks are participating, but to open it up for the brokerage firms, for the other financial institutions rather than the banking sector, as well as for individuals. And we are, at the Egyptian Exchange, we have the infrastructure ready for trading that, and hopefully the government might start with a $5 billion issuing before the end of the year. If it's again well designed, it will be listed, it will be traded, and I think it could be like a sort of a spillover effect. If it's well designed and if it's successful in the secondary market, actively traded, this could convince the policymaker after that to open it up for even the 200 billion Egyptian pound outstanding bond issuance from the government to be traded as well in the stock market.
I can bring our man from Emirates NBD in on this, on the issue of Islamic financing. Is this something that institutions here can get into Africa and get involved with in Africa?
Absolutely. Just to put things in perspective, Islamic finance is a relatively nascent form of finance, if I could say that. Only 1% of the global global financial assets are Sharia compliant, and that still equates to about $1 trillion worth of Sharia compliant assets today, growing at a rate of anywhere between 12 to 15%. What we've seen is Sukuk has attracted the most attention. It's commonly known as the poster boy of Islamic finance. And within the Sukuk industry, we've seen very strong growth numbers in the recent past. In the first quarter of 2010, about $7 billion of Sukuk was issued. In the first quarter of this year, already $30 billion worth of Sukuk has issued. And we are quite confident that this year is going to be a record year for global Sukuk issuances. What it still entails is the fact that it is still an alternative means of finance. It provides you with diversification. It gives you, as of today, probably some savings on your profit rate or your interest rate, but it is not mainstream finance. And it is one small aspect of a funding that any CFO based in the region today or sovereigns in the region today look at. If I could, probably use the example of Turkey. Turkey issued a bond in January of 2012. Less than 2% of that was bought by Middle East investors. They issued a Sukuk a few months later in June of that year, and more than 50% of that Sukuk was bought by Middle East investors.
Is this a hint for African issuers that if you want to attract money from the Middle East, if you structure it as an Islamic bond, you're going to get the money?
That is correct. I mean, Indonesia has done it successfully. Malaysia has done it successfully. I think increasingly there is a risk appetite, which is important. But what's even more important is there is this huge pool of liquidity. I think ENY had a report a few months ago stating that the demand for Sukuk as of today is 3 times higher than the supply. And therefore, there is a pricing mismatch. But more importantly, they don't expect that gap to close anytime soon, which means all these Islamic banks growing at 20% a year have very few avenues to put their liquidity at work, and issuance from the African continent would be looked at very favorably by investors not only from this part of the world, but also from Far East.
Just one point I want to draw out on this before we move on to the next issue I'd like to focus on. But if I can ask Stella and David this, because you're based in East Africa, surely there is also potential demand and potential interest for investing in an Islamic bond, perhaps rather than a conventional bond, there as well anyway.
Yes, I would just like to state that, for example, the first ever infrastructure bond that was ever issued by our government through the Central Bank of Kenya in 2009, actually the Gulf Bank, which is a bank, an Islamic bank in Kenya, worked with the Central Bank of Kenya, as well as, somehow their Sharia compliant board to actually have a Sukuk component of that infrastructure bond. So there was massive take-up again by the Muslims, and even we at the Capital Markets Authority, there was what you call issuance of our unit trust, which was called the First Ethical Fund. Again, that was massively, it's a collective investment scheme, and that was again massively oversubscribed by both Muslims and non-Muslims. So at the end of the day, there is, I do concur that there is going to be demand for the Sukuk component, and I believe it is time that we will see just a regular Sukuk bond rather than it being part of the wider bonds issuance.
Yeah. Actually, Robin, if I may take your place, I'd like to ask you a question. given we can flip the script here because I
No,
think
you're the experts. I'm not the expert.
the point is, I think there's two strands to this. One, we can, as Stella is saying, get a domestic issue, so tap into our local capital markets and issue for the domestic and the wider world, in the sense that there is uptake for that and an appetite for that kind of structure. And the other strand to it is come to Dubai in the spirit of this conference, and come to Dubai and essentially market a domestic, i.e. Dubai issuance for some project in East Africa or Africa for that matter. I don't know, from your experience here, what is your sense on which one of those structures would work?
I see no reason why you can't actually do both. And in fact, the same structure, the same instrument should appeal both to the international investing community, and if we're talking, as we are just for the moment, on an Islamic structure, then that obviously ticks boxes here, and you have people here, and you have institutions here, and I do mean people because you have high net worth, ultra high net worth individuals here, family offices, you have institutional investors here, as Hitesh was saying, you have the Islamic banks looking for somewhere to park their liquidity. So you've got a constituency here that would invest, that would find such instruments interesting. And I am also firmly of the belief, when I look at the continent of Africa, and you have 25% of the population of the whole continent of Africa is actually Muslim.
Yes.
You have a rising middle class, which is a point that, Emma, you were making earlier, with disposable income, with income they want to save. And as we said earlier, these are people who want to invest, whether they do it as individuals or whether they do it through institutions investing for them because they've saved with a pension fund or a mutual savings scheme or a fund management scheme. I believe there is both a marketplace domestically within Uganda, within Kenya, pick a country, as well as there being an international audience that would be receptive as well.
But David, I just would like to be careful about one point, because we are limiting our discussion about the Islamic finance in terms of Islamic sukuk. Of course, there is many Islamic products. I mean, there is Sharia compliance indices, for example. You have Dow Jones Islamic Index, you have Financial Times Islamic Index. And I think a big part of, as well as, is about the equity trading, because there are many investors, Muslims people as you're mentioning, they would like to access the stock market, the equity market, but they are trying to invest in Sharia compliance kind of companies. So I think one of the other things is that either inside African continent or outside, that people who are looking for the ethical investment, and the literature or the history taught us that, or showed us that the investment in ethical investment or the Sharia compliance kind of indices, they are providing investors with abnormal returns compared with conventional investors, a conventional investment. So it's not only limited to the sukuk or bond Sharia compliance, but as well as to the equity Sharia compliance products.
David, when you finish structuring your ETF, there's your next job. Thank you. All right, let's move on to there's one more topic I'd like to explore before I start getting you involved. We've talked about infrastructure, we've talked about companies. Every company starts off small. Every business was a small business once. What Africa has is a need for infrastructure. What it has is a young demographic, and therefore a need for job creation, a need for project development and project finance. Commercial banks hate project finance. Right. Commercial banks will not, I am told by commercial bankers in Africa, touch project finance unless the African Development Bank is involved, because they want that aid and comfort. How do we get around that? Can we get around that?
You're talking about any project finance or specialized to SMEs, because SMEs,
well, starting off with any project finance, and then we'll come down to the
I might disagree with you, because if you are a well-known company, you do not have any problem to deal with the banking sector for the project finance. But the problem actually with the SMEs, and this is, if you look to any economy, most of the economies, even Japan, you will find that 80% of the GDP is coming from SMEs. 70–80% for employment is coming from SMEs. As well as the same things might apply for the African continent. I do not have specific numbers, but in Egypt, for example, you will find that 65% of our GDP is coming from SMEs, 70% of our employment is coming from SMEs. However, the participation or the share of SMEs in capital formation does not exceed 4%. They have a problem. They have a problem of access to finance. And you rightly mentioned that banks hate project finance, but I would add, especially for SMEs. 92% loans or credit to the private sector from the banking sector are going to the big companies. Only 6 to 8% going to SMEs. Although SMEs participating by 60 to 70% from GDP and total employment. They have a problem, and I guess there are a couple of experiences in Africa. I guess the Altex in Johannesburg, they have a platform for SMEs. In Egypt, we have it 5 years ago. We create a platform called NILEX, which is Nile Stock Exchange, to have access to finance designed and tailored to meet the characteristics of the SMEs. We have many global experience. I guess, according to my knowledge, there are more than 39 platforms for SMEs. The famous, of course, is AIM in London. You have Mother in Japan. You have Altex in Johannesburg. And even if you look to experience with the United States, NASDAQ, when you have New York Stock Exchange, and then you have a NASDAQ in the beginning, of course, now it's IT platform, but the beginning was for the smaller companies. So I think, given the economies of African continents and the structure, how the economy is working, I guess the SMEs would be the main driver for the economic growth in Africa, and this is why they need access to finance. And because the banking sector more or less is ignoring them, we need to find a better way to access to finance through the capital market.
We've seen some innovation again in East Africa, looking at also what has happened in the rest of Africa. I think Egypt as well as South Africa have a board within their stock exchange which caters for small, medium enterprises. So Tanzania and Kenya currently, and Uganda is about to join, are obviously in a process where they have what you call a growth enterprise market segment. This is a segment on the board of the stock exchange which caters for the small, medium enterprises to actually list and be able to raise capital. All they need is they need to have a nominated advisor who is going to be their sponsor for the duration of their listing. That is something that is innovative within Africa, and it allows that SME to actually raise capital. And it also, most importantly, if you know about the fact that the private equity has really grown in Africa, and especially in East Africa, it provides a mechanism, an exit mechanism for that private equity to actually exit at some point, be it 5 years or 7 years, but it actually allows the SMEs to start having order, to start having the corporate governance that is required, to start keeping their books in a proper manner, to start also being recognized by the rest of the world because of that particular listing. So the benefits are numerous in terms of that. The other innovation that has also benefited the SMEs has been the fact that in Kenya they are also able to save through the pensions. So as an SME, they are able to make a contribution to the pension sector by saving. We have what you call 20 shillings, which is sort of like $1 a day. They're able to send that through what you call the mobile phone platform through one of the banks that we have, and they are able to send that through their fund manager, and that money is actually used as saving, and it allows them to save for their retirement at the same time. But that money again goes to the pot of the pension sector, which is again the pension fund manager is able to now use that money to invest either in infrastructure or otherwise. And these are very good innovations.
I'm conscious time is starting to get away from us. Yes, hold on. You shall be first, sir. There's a hand shot up there like a rocket. We did start a little late, so I will keep you a little later than the advertised time, but let's throw it open. The gentleman here in the second row was first by such a long way. There's a microphone coming, sir.
Yeah, I am Murthy. I am a financial services consultant and also trainer based in UAE. I'm CEO of the company. And I was in capital market regulator in India, and I was also partly in SEC. Now, a couple of pointers I want to suggest. Probably you can throw some light. At the end of it, you are going to inspire the outside world to for capital flows. The prerequisite for that is the capital market integrity in your respective countries and the risk-return trade-off, which is very great prerequisite. And how far the regulations are in place, what is the capital market integrity in your respective countries. These are the things which will come into the fore. I don't think any emerging market will improve or take a forward stride without attracting foreign capital. For that, the prerequisite is capital market integrity, A. B, you should have a very good capital market instrument and depth of the market in place. Then only you can inspire the outside world to come and invest in your respective countries. Thank you very much.
Thank you. A statement, not a question. Thank you. Gentleman in the front row here. And then there's a gentleman at the back there. So you'll be third, sir. And you'll be fourth. Fifth, slow down.
So just to continue with what he's asked, my question would be to Stella, and maybe Amir and David can add. My name is Amir, working in capital markets for Infotech in Africa for the last 6-7 years. We talked about harmonization. My observation has been that different capital markets and LCCs within Africa are at a different level of maturity and understanding. So how do you think that harmony would come when all these regulators are at a different level of understanding?
Okay, I can answer that now. Thank you for that question. What I would propose on my end is really having what you call regional economic community hubs. For example, East African Community is one hub that allows us to be at the same level of harmonization. And that's already happening within the East African. We have the East African securities regulators who are actually working towards a harmonized capital market structure that will allow even recognition of securities brokers. And this has all been made possible by the fact that in 2010, the East African Common Market Protocol was signed, and in about 2014 we will be having what you call an East African Monetary Union. So separate from that, within that monetary union there are certain structures that are happening within the capital markets, and so the harmonization is there. For example, I've said we have already issued an asset-backed securities regulation. The rest of the other countries are actually looking at it to actually see what are the lessons and whether they can just translate that or what will work with their governments. The private-public partnership, again, is a law that was passed in just last month in Kenya. The rest of the other countries are also in the process. I believe Tanzania has already passed it. But again, looking at how can that work for the rest of East African community. But again, I think I would not belabor the point. Having regional hubs, so if you look at ECOWAS in West Africa, again, they can take one or two things. How do they cross-list? How do they make their cross-listing easier? And we have had that success as well within East Africa. For South Africa, again, having the SADC as a hub. So that's the only way I would see that working, not necessarily having the whole country or the whole continent harmonized.
Amy, I think you wanted to say something.
A very brief comment on West Africa. OHADA is there, which is the harmonization of business laws, and they actually have a common market and a common currency. So in West Africa, there is a lot of that harmonization underway. So, you know, East Africa isn't the only place to invest. It is the whole continent. The whole continent is trying to attract business, and there are a lot of initiatives exactly through these regional integration strategies.
So it's probably my fault. I ended up talking about East Africa because we have a strong East African representation on the panel. David,
Yeah, I think it's to be attractive, as one of the speakers said in the plenary earlier, is that you need to have the quantum in terms of market size to be able to attract the equivalent or commensurate value in terms of capital. So we realize that if it's a small market with, say, a market cap of $1 billion, you really won't be able to walk the catwalk and get the right level of attraction. So part of the harmonization story around East Africa, and certainly in West Africa, I'll give you an example of infrastructure play between Kenya, Ethiopia, and South Sudan in terms of LAPSET infrastructure. That is an infrastructure enabler that really gives a value addition to every country. So they do realize that they cannot do it piecemeal. Plugging in together is the best way to do it. It essentially takes your cost of doing business down. And I think from the capital markets perspective, as Stella is saying, that regional play that makes it more attractive is the way to go.
Okay, we probably fit 2, perhaps 3 more questions in if we get short questions and short answers. There's a gentleman, I'm going to stand up now, I can because my microphone allows me to move around. There's a gentleman there, then there's a gentleman there, and yes, you'll be the last one, sir.
Yes, my name is Ibrahima. I'm from the African Union. I just want to share an information to the participant to this panel. We, African institutions, we have drawn up an infrastructure program called Program for Infrastructure Development in Africa, which has been led by the African Development Bank. The feasibility study talks about 360 billion for the next 20 years, 70% out of which we are looking at domestic resources. And it's mainly energy, transport, and ICT projects. So those of the participants who are interested, we are planning to organize in Addis Ababa late this month an African business forum in which we will have an interaction, quite wide interaction with investors who are interested from within the continent and also from outside the continent. To make sure we move that PIDA forward, the African Development Bank is developing the Africa Infrastructure Financing Facility that has been discussed a couple of days ago in Washington. And we are looking for an internet solution to build our infrastructure.
Gentleman in the middle of, there he is, right.
My name is Alex Inhare. I'm from Rwanda, from the Private Sector Federation of Rwanda. I'm very interested, probably I came late, but I'm very interested to learn more from Amil. He was very quiet today about the facility that they have. So, unless...
Did you plant him?
I didn't plant him. But thank you. I'll give you the very brief thing. What the legal support facility does is we advise African governments in the negotiation of concession agreements, primarily related to foreign investors coming in and doing business with the governments. We also then help governments clear out some of the threats to entering the capital markets on the sovereign debt issuances by addressing some of the outstanding commercial creditor litigation.
Okay, advert over. Gentleman at the front, and if you're quick, we'll squeeze you in as well, sir.
Good day to everyone. I think my question would be most suited to Mr. David. Basically, considering that there's a new concept in the financial world, which is crowdfunding. So, and considering what Dr. Amran said, which is only 4% of the funding is going towards SMEs. So, why isn't there some sort of crowdfunding platform set up to cater to all these SMEs? Thanks.
Well, I think that's something worth considering. I think if you go back to Kenya, we need to really get IP on some of these things, because in Kenya there's a concept called Harambee, where if you're raising money for a business or if you need to go and study in India, etc., the entire village essentially crowd funds for you. But on a more serious note, I think within the capital markets there's the OTC framework, where I think quite famously Equity Bank, before they went for full listing, had a closed cluster of investors that essentially gave them a depth of sophistication in terms of knowing what the markets would be, raised long-term patient capital, and enabled them to tick those check boxes in terms of governance, etc. So I think that essential boiling hub, whether it's from I think the US essentially, I think last year passed the act that enabled crowdfunding. I think it's something that can be plugged in or formalized because it's there in some shape or form.
Right, our final question, right next to you, that's...
Hi, my name is Falk from Pelican Capital. We have activities in Africa. I'm a numbers man, we're entrepreneurs. There are 1.6 quadrillion US dollar denominated derivatives floating in the global financial markets. The global GDP is 63 trillion. Deutsche Bank has 60 trillion on its books, Bank of America 90 trillion, JP Morgan Chase, I think 130 trillion. It's going to blow. It's a question when, not if. Why are you copying financial systems, introduce them to Africa, only to end up in a mega disaster? It is incomprehensible. Haven't you seen what happens in Ireland, Spain, Portugal, Italy, Greece, Cyprus? I think Africa is extremely strong on its own, but there have to be other systems developed in order to make sustainable growth possible and to create wealth so that there is purchasing power put into people's hands. We have an office in Nairobi. There are 3.5 million people living there. 2.5 million live in slums. Is anything going to change? I don't know. I only know one thing. We have businesses all over the world. The most competent and the most responsible people I have met are Africans, because they are not entitlement jockeys. They want to get things done. They need help. And if the 400 million euro bond issue for Rwanda is praised as a great thing, I think it's criminal. It's 50% of Rwanda's GDP. You just indebt them. And a lot of African countries are debt slaves. This has to stop. If it doesn't stop, you're going to blow out. In December, we pulled all our money, cash, out of the banks in Kenya and other African countries because we don't want to become creditors. People were looking at us and said, why would you do this? I said, just wait when you see what happens in Cyprus and other countries. They're going to do a bail-in. If something goes boom here, we don't want to become shareholders in the bank. We are creditors. So I think I'm very impressed with you. I think you're on a good track, what you do, but if you don't rethink your strategy, you're going to get wiped out. Trust me, you're going to get wiped out because the Western financial system is going to crater, and it's going to happen very quickly. The central banks are printing money like crazy to keep the banks afloat. If the interest rate only goes up 0.5%, 90% of the Western banks are finished. And you've seen what the Japanese are doing to the yen. This is irresponsible. It's criminal. And it just impoverishes people. So this is what I have to say. We are committed to Africa. We work there. It's very difficult, very frustrating at times. We would like to work with you, but on our terms. It's not a question of capital. We have to stop debt financing. We have to go to the ground level. We have to empower people. Only if they produce a little bit more than they consume will there be wealth created. There are no secondary industries in Africa to speak of. There is no copper refinery. There are only 2 precious metal refineries, one in Rand in the south, and the Sudanese built one. Why isn't there an East African precious mint refinery? Why? I could tell you why. Because it's not wanted. Why can't Uganda export its bananas to the European Union? You guys have to do your homework. We're more than happy to help you. We can't do it alone. We have to have strong, reliable partners. It's the most difficult thing to find. Capital, not an issue. It is a problem to marry capital with good projects on the market. And we don't believe in debt at all. We do it equity and equity only. Zero debt financing. All these papers you issue are IOUs. And by the end of the day, they go poof up. If you and your pension funds go and mark your asset to market, 90% of the assets are gone. CalPERS, the largest pension fund in the world. I know the people there. I'm an old guy. Muzungu, Mbuze. If they would mark to market, 90% of their assets are gone. How are they going to pay their pensions? 30% inflation in Kenya. This has to stop. We have to come to a commodity-based money system that kills inflation. So that's all I have to say. And thank you very much. It has been extremely enlightening what you have to say.
Would anyone care to respond to that?
Because he mentioned a very good point in the beginning when he was saying why African continent, or even any country in Africa or the Middle East, they are copy-and-paste the financial system in Europe or in the United States, given the big differences among the countries here and there. This is quite right. But at least you have a minimum kind of financial development, you should have it in place. You should have an equity market, you should have a bond market. But now is the argumental issue. Do we need to go to very sophisticated financial instruments? Do we need to go to derivative exchange, for example? This is the issue we need to discuss. But at least you should have the minimum level that will allow you to have the two kinds of access to finance, the fixed income as well as the equity market. But I completely agree that Africa should make it simple as long as it's working. And even the history and the statistic tells that. I mean, during the financial crisis in 2008, Africa continent was the lowest in terms of negative return. I mean, the emerging market, Europe, for example, they lost around 69%, 70%. The BRICS countries, 60%. The Middle East, 57%. Asia, 54%. Africa, only 42%. So the misperception is that Africa is providing investors with higher return and with the lowest risk because they are keep it simple. But to what extent simple? At least keep a fixed income, keep as well as the equity market, but think about it again if you would like to go to more sophisticated and complicated financial engineering and financial installment in terms of derivative and so far and so forth.
I'd like to hear from the investment banker next because I think your profession just got profoundly trashed.
Well, I mean, I think what was discussed, has some roots in the way Islamic finance was originally professed. The fact that you cannot rely on debt and you need equity partnership. There needs to be risk sharing. If a project does well, you make money. If a project does not do well, you stand to lose. But that concept is not implemented as it should be, unfortunately. And I, to a large extent, I do agree. Excessive debt is sad, and the way things have panned out to be. I mean, I was seeing numbers for issuance from Zambia, for example. Their public debt to GDP ratio is less than 25%. And that's their strength. The fact that they didn't have access to the international capital or hot money pouring into their country made them more resilient and made them take less debt, which now makes them attractive to investors sitting outside Africa. When they look at that, when they look at 6% to 7% growth, it is a fantastic opportunity for investors to bank on. Moderation is key, and I think as long as things are done in moderation, there is place for fixed income, there's place for equity, and there's place for all kinds of capital structures in between.
Very briefly, I want to, I'm not going to tackle the issue of the financial systems of the world. That's beyond my scope. But I do want to point out one thing, and I want to emphasize the misperceptions there are about the size of the African economies. A 400 million euro bond is not 50% of the GDP of Rwanda. The GDP of Rwanda is over $6.5 billion, and it's growing at 8 or 9% every year. The only thing I wanted to emphasize there is that there's a clear gap in the perceptions of what is happening on the continent, and there's, compared to what's out there in the market and what the perceptions are. And I think that extends to the rule of law. I think that extends to the regulatory enforcement mechanisms and the policies that are in place. I think investors haven't caught up with what Africa is doing, and they're a little bit behind the game. And I think that's why this forum is an excellent opportunity to catch everybody up.
And Stella, and then David, perhaps a closing word from you as well.
Okay. My take on this is really to ensure within Africa, as you said, that there is a process for savings, and then there's a process to ensure that the savings are actually intermediated into the long-term financing, so that you necessarily can use equity, but you can also have debt options. Because as you know, if I'm an investor, or if I'm an owner of a business, it has to be my prerogative whether to use debt or to use equity. So in that regard, from a perspective of investment, it is important and critical for the capital markets to have really what you call alternative investment or diversified investment, so that you're not just thinking about equity or bonds. What we talked about here, we talked about Islamic finance, but that's really towards the issue of diversification. The other area of diversification is looking at other investments which are there in Africa. For example, real estate investment funds. How can this be channeled towards mobilizing of capital? So you have real estate investment trust. You also have private equity. Then we also have derivatives. If you look at South Africa and some of the other commodity exchanges in Ethiopia, Rwanda is about to have one, which is going to be within East Africa. Again, that's another alternative. But what all these provide, and what you call fund of funds as well, is they provide alternative ways of actually saving and investing, but also they provide an intermediation mechanism for the ones who want to issue debt to be able to have, pool of capital to allow them to be able to, to actually issue debt. So I would suggest that from that perspective, not all is lost. These are all work in progress, and they also go hand in hand with policy. It allows the government to prioritize what are the key industries that we will be looking at. Is it manufacturing? If that's the case, then the need for electricity will be there. Then how do we finance the electricity production so that these industries are there? And that's why we're talking about the big projects, for example, the Lamu port project as well as the pipeline projects in Uganda and Kenya.
And a final word from David.
It's sword out of sheath time, isn't it? But very briefly, I think the points the gentleman made valid. But I know it's courtesy to do this, but there's a specific distinction that happens in Dubai. This forum specifically is a platform where on the podium, we're not getting preached to from the pulpit. I think we've gone to other places where we sit in the office and they're prescribing solutions for Africa. I think we can only get to smelting those ores or those minerals in Africa if a dialogue that has equitable balance in terms of participation and healthy debate that we don't always agree on, but somewhere where there's really a 50-50 throw into the pool. I think I just have to take my hat off for the organizers of this, and we look forward to coming here again and discuss it. That's me.
Ladies and gentlemen, I have enjoyed the last hour immensely. I hope you have. Would you please show your appreciation for your panel? Thank you very much for your attention.